It is my pleasure to introduce a member of our uh, Committee on Financial Matters and Retirement, and today's program coordinator, Millard Sussman, for the purpose of an introduction of our speaker. So Millard, it's all yours.
Thanks, Sandy. Well, good morning, everybody. It is a beautiful, bright, sunny day. And here we are back at our our stations in front of our computers. Before starting, I'll remind you that this year the Retirement Association has chosen the Open Seat Food Pantry at the university as its target charity. If you want to make a contribution, you can send Sandy Haas a check made out to the University of Wisconsin Foundation with Open Seat Food Pantry on the comments line. The food pantry helps UW students to cope with food shortages and other financial emergencies. And all of them are more common these days now that we are in a pandemic shutdown mode. Today's talk is a new departure for the Committee on Financial Matters and Retirement. We've never touched this topic before, and I am pleased to introduce our speaker, who has been one of the pioneers in this field. Tom Eggert is a member of the Retirement Association, member of the Financial Matters Committee, and he's emeritus from the Nelson Institute of Environmental Studies, where he's taught courses on sustainability and corporate social responsibility and systems thinking. He taught the first UW class on sustainable development back in 1994. He is founder of the Wisconsin Sustainable Business Council. Before he joined the Nelson Institute, he was a founder and director of the School of Business Graduate Certificate Program in Business Environment and Social Responsibility. He has BS and MA degrees from UW-Madison and a law degree from George Washington University. And it is my pleasure and honor to introduce Tom to you to talk about sustainable, responsible, and impact investing, post-pandemic and post-election recommendations. Tom, take it away.
Thank you, Millard. So I have shared my screen. Millard, can you let me know if it is showing up? Yep.
It is showing up.
Excellent. It's always one of the challenges. Thank you very much for the invitation to speak. One of the things I will ask is if there are questions as we go along. I've asked Millard to sort of drop in and ask your questions, because I know too many times when we're sitting in webinars, we think about something that there was a question early on, and then we hear a bunch of other things, and we never end up going back and asking that question that came up. So today I want to talk about sustainable, responsible, or impact investing. I'm going to call it SRI. And then I'm also going to weave in some post-pandemic and election recommendations, because you'll see how they fit within that SRI universe. So let's see if I can make my screen. There we go. SRI, what is it? So we're very comfortable with the idea of financial goals, maximizing return on our investments, looking for things that either provide us a regular stream of income or a bigger payout because we're going to hold it for a while and then sell it. So the financial goals are very traditional, and we're all very comfortable talking about financial goals. What we add in when we start talking about SRI is the impact goals. Those are positive social and or environmental outcomes that resonate with us as investors. So my values, my convictions, things that I believe about the world can be integrated into investment decisions. What's I think unique about the time that we're living in now is that there are people that study these things, and we'll talk about a couple of those studies. They've shown that we actually can do better from an investment perspective, that the long-term results are outperforming results of the S&P, the Dow, whatever generic index you're following. For instance, we'll talk in a bit. There is a S&P SRI fund, so a socially responsible fund that tracks the S&P, that simply leaves out petroleum companies that generate profits and return from investment in petroleum resources. Not surprisingly, or maybe surprisingly, when you leave out petroleum companies from the S&P 500, you do better. You do better in 2020, you do better from 2018 to 2020. You actually do better over a 5-year period. Petroleum has not been a good investment from a return perspective over the last 5 years. So when we talk about SRI, what are the criteria that go into saying something is an SRI investment? So we talk about 3 criteria: environmental, social, and governance criteria. And these criteria are a set of expectations for a company's operation that reflects their commitment to their shareholders, to the environment, and to their workforce. So let's talk a little bit more about that. The E of the ESG is environmental. They look at the performance against standards, are they complying, but also performance that benefits the environment, their overall orientation. So most of you are probably aware carbon emissions are not a regulated emission at this point, yet there is a lot of interest in carbon for climate reasons. And so most companies now in the S&P are, well, 95% of companies in the S&P are doing a sustainability report, and most of those reports include a carbon element to it. That is not something that is required. It is something that they're doing because there is interest on behalf of investors, supply chain, employees, customers, a whole number of different criteria. In addition to the environmental criteria, there are social criteria. How a company manages relationships with its employees, with its community, suppliers, customers. So sort of the social elements of it. And then governance criteria, how the company deals with leadership, including diversity, both women and people of color in management positions and on the board. Benefit decisions for employees, executive pay, transparency, internal control, shareholder rights, all of those kinds of governance kinds of things. So together, environmental, social, and governance criteria are the underlying criteria when we talk about an SRI investment. So why are people interested in socially responsible investing or sustainable, responsible, or impact investing? So first, the first obvious reason is personal values and goals. They want to make investment decisions that reflect who they are, what their value set is, what they believe in. For others, it could be institutional mission. Many nonprofits now are using SRI criteria for investing the money that they have. That is not something that they need on a month-to-month basis. And I'll spend a lot more time talking about this belief, which is supported by research, that with less risk, which companies that do a good job managing those ESG criteria, environmental, social, and governance criteria, they experience less risk. They're better managed companies. They do better. If you invest $10 or $100 or $1,000, you are more likely to have a higher return with an SRI investment than you are with a non-SRI investment. Also, and we'll talk, I'll have a chart on this in a minute. When you look at the investing world, there's the group of millennials, and now millennials dominate the workforce. They have a belief that their decisions, whether those are purchasing decisions, quality of life kinds of decisions, and also investment decisions should reflect the values that they have. So there's this demand not only for attractive returns, but also for generating a positive environmental or social impact. And it's not just millennials. So it's baby boomers also that want investments to do more than simply make money. They want to invest in companies that are going to bring about change. So a wide range of individuals, from millennials to nonprofits to institutional investors, are making SRI investment decisions using these new assessment tools that connect the environmental, social, and governance criteria and performance with financial performance. So I want to spend a little time with this chart. So at the bottom of it, you're going to see, no, at the top, this was in 2015. So who is doing SRI investment? So 6 years ago or 5.5 years ago, 67% of millennials, then the next generation, the Gen Xers, 44%, my generation, the baby boomers, 36%, and then the greatest generation, 34%. So that was 6 years ago. I pulled up the new numbers from this yesterday. Millennials now, what percent of millennials are using SRI as an investment vehicle or making SRI investment decisions? 95% of millennials say that they now are making investment decisions driven by these ESG criteria. With Gen X, that number is up to 55%. Baby boomers, that number is up to 49%. And the greatest generation up to 39%. So big change between the millennials, where 95% of them now are reporting that they are making decisions that are consistent with a integration of values in investment decisions, versus, as you come down, versus the greatest generation that by and large, I think probably hasn't heard about how you might integrate values into investing decisions, but they're coming along. What kinds of options are we talking about here? So certainly individual stocks, mutual funds, which are simply collections of individual stocks, exchange traded funds, these ETFs, which are another version of a collection of individual stocks. And then for those that are looking for fixed income kinds of things, green bonds, green bond funds, and other alternative investment options. And I'll talk about some of those at the end of the presentation. So what are the factors that are driving interest? And this is more of the analytics kinds of factors. So certainly growing public interest in climate change, water, diversity, social justice. These are all things that are in the public discussion these days. And certainly that's not to be dismissed, but that's not the analytics side. The analytics side is the growth of analytics and sophisticated modeling. I'll explain what I mean by that in a moment. The growth of research that links effective management of sustainability issues to strong financial performance, and the shift in attitude among investors about the connection between strong sustainability performance, value creation, and risk reduction. So when you talk about value creation, risk reduction, you're talking about financial performance, economic performance, stock market performance. These stocks are going to go up. So that last part is a shift in attitude. Investors believe that the market is going to reward companies that are sustainability oriented. Miller, did you have something? You popped in there for a moment.
I have a question.
Yes.
Isn't there some social desirability bias? People say they're making responsible investments, but objectively, are they? It's like asking, are you ethical?
So it's a great question. We'll talk about in a minute, how do we decide, or who decides? We'll talk about both the who and the how of which companies are deemed to be operating in a socially responsible way. But yes, it's sort of a, we're deferring to somebody else, somebody that is saying, we have this list of questions that we are giving to all publicly held companies, all companies that have stocks that are traded, and we're using their responses to those questions to determine which ones are strong in the environment, which ones are strong in the social criteria, and which ones are strong in the governance criteria. So there is certainly, sort of as individuals, we can say, oh, I feel very strongly about Unilever. They're a popular long-term sustainability play. They make, cosmetics and shampoos and things like that. And I may, have come across that, or I may have seen some of their ads that they have run on TV on sustainability. I say, okay, that might be one that I like because I like what I've seen. But there are other more regimented, more analytical ways of deciding which companies are strong ESG kinds of companies. So I'm going to spend some time going through each of these 4 points because I think the analytics side is really the new contributor to why SRI investments are growing so quickly and really should be part of everyone's portfolio. So the first one, growing public interest in climate change, water, diversity, social justice. As I said, it's not just millennials that are making purchasing decisions based on the environmental or social criteria of the business that they're buying from. I think the best example in the Madison area is Penzies. Penzies has taken very strong stands, regular stands on progressive environmental or progressive issues. And they have attracted a following because of that. Most of us are familiar with Penzies and, and the sort of the positions that they've taken. I'm up in Rhinelander. Minocqua Brewing Company is the Penzies equivalent up here, where actually they run their own super PAC on progressive issues. And so, people are attracted to companies like that. Of course, not everybody. Some people would never shop at Penzies or Minocqua Brewing Company, but that's a business calculation that these businesses have made, that there is an audience to be appealed to, and this will be good from a business perspective. Purchasing decisions are then being made, and companies are being rewarded for the positions that they're taking. And then the second point there, an increasing belief that business bears the responsibility for solving environmental and social issues. This is really what I spent 25 years teaching about. And where was leadership coming from in the sustainability space? Generally on issues that would be included within sustainability, climate change, diversity, racial justice, those kinds of things, we would expect the government to play, to be in the lead. But over the last 20 plus years, that hasn't been the case. The federal government hasn't been a player in the broad sustainability field. Some state governments have, some local governments have. But in the absence of other leadership, business, by and large, stepped up and took on that challenge, not for altruistic reasons, for very sound business reasons. But that's why I mentioned earlier that almost all of the companies that make up the S&P 500, so the 500 largest publicly traded companies in the US, produce a sustainability report. There is no requirement that they produce that report. They are doing that because of this increasing belief that business bears responsibility, feedback that they're getting from investors and other shareholders or other stakeholders, and sort of this drive to be a leadership kind of company. October last year, more than 1,000 companies with a combined market cap of $15 trillion, including 1/5 of the global Fortune 500, made commitments to setting science-based targets for reducing emissions in line with the Paris goals. So as the Trump administration pulled the US out of the Paris Climate Accord, business by and large responded by adopting emissions goals that were consistent with the commitments that were required. This was not something that was required that they do. This was something that they decided was the right thing for them and the businesses that they were operating. Okay, the second driver of interest in SRI, the growth of analytics and sophisticated modeling. Bloomberg, Thomson Reuters, BlackRock, we'll talk about Morningstar in a minute, all now collect data on ESG issues. They have specialized departments that gather this data, analyze it, rank companies, and produce replicable, information that is useful from an investor perspective. Research linking effective management to sustainability issues to strong financial performance. So this is the role of the universities. Harvard found that strong ESG performance correlated with strong valuations, revenue growth, and lower costs of capital, a fancy way of saying these companies perform better on the stock market. And significantly, they outperformed sector peers in terms of stock market performance. And then the shift in attitude about the connection between strong sustainability performance, value creation, and risk reduction. Again, fancy way of saying overall stock market performance. MIT found that 60% of investors believe that companies with a solid sustainability performance are less of an investment risk. Less risk generates higher returns, generates higher stock prices. 60% of investors strongly believe that solid sustainability performance lowers a company's costs of capital. So as companies have to borrow money to grow, to add inventory, to do the things that companies do, with a strong sustainability orientation, their cost of capital is less than others that don't have that same orientation. The overall conclusion, so of a study that was now almost 4 years ago, was that investors believe that good sustainability performance is a sign of good and effective management. Good and effective management then translates into a company that's going to do well and be a target for investment. So is it really happening? This is the growth of money in screened investments. So ESG Incorporation, these companies are being ranked, they're being included in mutual funds that are SRI kinds of mutual funds. And you can see that it's almost a geometric curve over the since 2012, 2013. The growth of money flowing into SRI investing, the growth of the field overall is tremendous. So from 1995 to 2020, that 25-year period, the amount of money invested in the SRI universe increased nearly 14 times, which is a compounded annual growth rate of 13.25%. The number of ESG mutual funds has grown to 977 plus an additional 116 ETFs. So again, the mutual funds and the ETFs, just collections of companies that have been screened and deemed to be high scoring ESG companies that are brought together into a portfolio. Let's talk a little bit about the other side of the investing world, and that's the debt side. For those of you that have bonds in your portfolio, whether they're individual bonds or bond funds, sustainable debt increased to almost $750 billion in 2020. That includes green bonds, social bonds, sustainability bonds. Green bond sales have been going up for the last 7 years. Every year, it's a record. That streak is likely to continue on into 2021. In the US, the largest, the organization has sold the most green bonds is the New York Metro Transit Authority that last year sold $2.7 billion of bonds that were certified under the climate bonds standard. Millard, how are we doing on questions? Okay.
No more questions at the moment.
All right. So that means one of two things. Either everything is perfectly clear or I've just completely baffled everybody.
Well, just a second. One just came in. Related to the above question, is corporations saying they're performing or trying to perform consistent with SRI? Is that just good advertising?
So it was to begin with, when the only criteria was what you were telling the world, then it was easy. With the growth of analytics, so that, you know, the BlackRocks, the Thomson Reuters, the Moody's, the other sort of financial organizations that now are evaluating ESG criteria, it is no longer, you know, sort of just what you get to tell the world. You have to demonstrate to them, just as you would the numbers side of things, you know, the data and the work that is behind each of the criteria, the ESG criteria that you're claiming credit for. So same kind of chart for the sustainable debt as we looked at for SRI investing, only this one is much more recent. Debt was a newer option in the SRI universe. So this goes back to 2013, but, you know, sort of a dramatic curve up. And I mean, I'm not one to predict the future, but if you look at how we are going to come out of this economic challenge, these economically challenging times that we're in right now, there is going to be a lot of green bonds and sustainability bonds and social bonds that are going to be issued that you know, are at least something to consider for adding to your portfolio. So I want to talk in a little more detail about something that's available to all of us. And probably most of us are familiar with Morningstar. And as we look at mutual funds or exchange traded funds, Morningstar provides rankings based upon how those funds have performed over time, with adjustments for risk and cost. Each investment receives separate ratings for 3, 5, and 10-year performance, which then are combined into an overall rating. These are your star ratings, right? So they're graded on a curve. The top 10% of funds or ETFs receive 5 stars. Again, 3, 5, 10 years, and overall. The next 22.5% receive 4 stars. The middle 35% receive 3 stars. The next 22.5% receive 2 stars. And the bottom 10% get 1 star. So if you take nothing else from this, this presentation, at least go back into your portfolio or ask your financial advisor, what are the star ratings associated with each of the mutual funds or ETFs that I hold? Because if you're not holding 5 and 4 star funds, or maybe 3 and 4 and 5 star funds, you're paying a price for if you have 1 and 2 star funds in your portfolio. Anyway, that's a diversion. It has nothing to do with SRI. That's just what Morningstar has provided historically. So the standard Morningstar star ranking is backwards looking. It tells an investor which funds have performed best over the 3, 5, or 10-year period. A common misperception is that Morningstar awards higher star ratings to funds it expects to perform better in the future. That is not the case. The stars from Morningstar are backward looking only. They also started about 7 years ago evaluating ESG criteria. So they do rankings of 4,500 companies worldwide. They have 100 questions in this ESG criteria world that they ask of those companies. And then company performance is assessed on those issues relative to other firms in their same industry peer group using a 0 to 100 scale. Those then are captured in what they call planets. And I'll show you an example in a minute. So individual companies are ranked by Morningstar. Then as mutual funds are created or ETFs are created, those are made up of those individual companies. So Morningstar also rates 35,000 funds on the performance of their holdings in those 4,500 companies. For mutual funds, the ranking is a holdings-based calculation using the individual company ESG data. So On the right side of the screen, you can see the little planets. Those are the equivalent of the stars. So that on this chart it's a very old chart, and I have some updates for it, but a traditional holding was Vanguard Prime Cap. The purple, or whatever color it shows up on your screen, those are funds with no SRI mandate. So the top and the bottom one are no SRI mandate: Vanguard Prime Cap, Fidelity Growth. The two middle ones, Parnassus and Domini, have an SRI mandate. So you can see the Morningstar ranking, which again is based on past performance. You can look at the sustainability ranking, which are the planets on the right side, to see what those tell you. So what it tells me, not surprisingly, the two SRI funds in the middle both have 5-star or 5-planet rankings. That is as expected. And then interestingly, not funds with no SRI mandate still may carry a high planetary ranking or rating, but that is by benefit of the companies that they chose for non-SRI reasons. So Vanguard Prime Cap does not have an SRI focus. Nonetheless, for whatever reasons they use to pick companies, they ended up with a 5-planet ranking rating. Fidelity Growth, didn't. It had a 3-planet rating. So again, I said this is actually quite old. I think this is about 5 years old. I looked up yesterday what the Morningstar rating on each of these mutual funds is now. So let me start with the two SRI ones in the middle. Parnassus still is a 5-star Morningstar, large cap. I think it's a growth as opposed to a blend. It's a large cap. It's not large cap value. So it's either large cap blend or large cap growth. Continues to do well, continues to have the 5-planet rating, continues to have the 5-star Morningstar. Domini went from 2 stars up to currently 4 stars. Which again makes that argument consistent. I mean, because they were a 5-planet mutual fund back 5 years ago, it was odd that they were, performing relatively so poorly. But they have their performance has increased dramatically. They're up to 4 stars and still 5 planets. So this whole idea that investors simply believe that companies that are better managed, that are more conscious of their impacts on the environment, on social issues, including community and workers, and then on governance issues, are actually better companies to invest in the long run, seems to be borne out. So any of us can take those Morningstar ratings of mutual funds or ETFs and develop our own investment portfolio, or tell your investment advisor that you want to start using the sustainability ranking or rating of the mutual funds or ETFs that you have. You could say, I want nothing but 4- and 5-star mutual funds or ETFs, and I want nothing but 4- and 5-planet mutual funds and ETFs. You can cross search both of those, and there are a number of options that will become available. How are we doing on questions?
I have one question for you. Do you know how much ESG investing SWIB engages in?
Yeah, great question. Not much. So when I was teaching, we had been pushing them for a while. Apparently they have a little experimental pot of money that they use for investing in early stage companies, local investments of businesses in the state that they want to support. And that was also including some SRI. But that was, again, probably 4 or 5 years ago that we had that discussion. It could be that it's much more now. I do know that it's not something that they talk about. So I think it's a really good question for a number of us that are retired to ask them. We're interested in, sort of because of these next couple slides that I'm going to show you, why aren't more of the investments, carrying an SRI criteria? So let's talk about how is the SRI universe done in 2020? A generally good year for the market. 73% of equity funds, so mutual funds, ETFs that are made up of stocks, ranked in the top half of their Morningstar categories. So what is that? Let's unpack that. So Morningstar has a category of small cap, mid cap, large cap. And then within each of those caps, there's value fund, there's value, it's a value grouping. There's a blend grouping, and there's a growth grouping. The growth grouping, by and large, doesn't pay a lot in dividends, and it is the growth of the stock market price that is what people are looking for. The value side, they pay more in dividends, and people are holding those companies both because of the dividends that they're paying and because they're expecting them to increase in value over time. So you have a number of different Morningstar categories. 73% of the funds, sustainable funds in each of those categories, were in the top half of all of the funds in those categories. So it's saying companies that are SRI focused are doing better than their non-SRI focused counterparts. 25 of 26 ESG focused index funds outperform their conventional index fund counterpart. I'm going to show you an example of that in just a minute. $347 billion of new money poured into ESG focused investment funds, which was an all-time high in a year that there was a lot of money that was sitting on the sideline because of the uncertainty about the economy. More than 700 new funds were launched globally in 2020. So let's look at 2021. According to Moody's, this will be the year of green stimulus as major economies, not just the US, but European and other nations' economies attempt to integrate their economic recovery and job creation initiatives with their longer-term efforts to reduce carbon emissions. So my argument, this is the year to make an SRI a part of your investment portfolio. Okay. So combining SRI principles, so things why we would be interested in investing in SRI options, whether those again are mutual funds, ETFs, individual companies, bonds, bond funds, combining those ideas with post-election investment themes. So what have we heard from the Biden administration as the top 4 priorities for the Biden administration? Climate change, COVID-19, economic recovery, racial, systemic racism. So the Biden administration, before they even took office, said those are going to be the 4 priorities for the early part of the Biden administration. So if those are priorities for the government, that translates to me to be the government is going to be investing in these areas and seeking to bring about change. So let's translate those into what the investment world views as investment options. So I broke those out as climate change, health and wellness, which is the COVID-19 thing, aging and improving lives. That's just because we're all older and we're all in favor of that. The increasing interest in diversity, systemic racism, water scarcity, and food, but which both tie back to climate change, and sort of the economic recovery is across all of those. So we have we talked about the S&P 500, the 500 largest companies. I mentioned the fossil fuel reserve free option of the S&P 500, which goes by the trading symbol SPYX. SPY is the S&P 500. So SPYX tracks the performance of the S&P 500 companies that do not own fossil fuel reserves. So it's just an index. In 2020, how did they do? They were up 20%. How was the S&P 500? Up 18%. We had 2 percentage points improvement in performance simply by leaving out fossil fuel companies. Over the 3-year period, 2018 through 2020, SPY-X was up 51%, the S&P 500 was up 48%. So these are index funds. These are not, there's nothing involved in trying to select the winners and losers. This is simply saying we're taking all of the companies in the S&P 500, but leaving out those companies that own fossil fuel reserves. That's the only change. And you're getting a fairly substantial increase in performance by leaving out those companies that have fossil fuel reserves. Now, as we look at the future, everybody's going to come about this differently, but I think we are past the petroleum age. I just don't think that fossil fuel companies are the next big winners over the next 2, 3, or 4 years. Maybe you do. Maybe you say that, you know, they've been down for so long, they have nowhere to go but up. And maybe that's right. But the results up to this point show that it is better to leave those fossil fuel companies out of your investment decisions than to include them. So this is an ETF. It's a fund that, it's an ETF is a fund, exchange traded fund, that addresses the issue of climate change by pursuing zero carbon footprint goals, clean energy providers. So ICLN is an ETF called the iShares Global Clean Energy Fund, invests in 40 or so companies around the world that produce electricity from solar, wind, and other renewable sources. How'd they do in 2020? Big year for them. Big year for solar companies overall. But so this fund, just this fund, was up 142%. Over the 3-year period, 2018 through 2020, up 218%. Year to date, they're up 5.7%. Health and wellness funds. Invesco, it's another ETF, DWA Healthcare Momentum ETF, goes by the trading symbol PTH, provides exposure to exchange listed companies with powerful relative strength characteristics from the healthcare sector. So, you know, companies that are leading in the healthcare area within their subsectors in healthcare. 2020, they were up 67%. 2018 to 2020, they were up 122%. They are up 14.8% this year alone, so year to date. ARK Genomic Revolution is another ETF, invests in companies that are expected to substantially benefit from extending and enhancing the quality of human and other life by incorporating technological and scientific developments and advancements in genomics into their businesses. This is sort of people that are trying to keep us all, companies that are trying to keep us all alive and longer and in better health. 2020, 1 year, they're up 181%. 2018 through 2020, they were up 299%. This is a big growth area. We talked about diversity and systemic racism and the Biden administration's commitment to this. There's an ETF that addresses this. Impact Shares NAACP Minority Empowerment ETF. Trading symbol is NACP. Invests in large and mid-cap companies that are empowering to minorities, and they define what that means. 2020, they were up 26%. 2018 to 2020, they were up 45%. So again, for reference, the S&P 500 last year was up 18%. And I forgot what it was up for 3 years. Let's just go back and look. For 3 years, it was up 48%. So that's the bottom line there. So that's what you're comparing these performances to. 18% last year and 48% over the 3-year period. Water ETFs, Invesco Water Resources ETF goes by the traded symbol of PHO, invests in companies that create products designed to conserve and purify water, up 21% last year, up 56% over the last 3 years. So there's lots of opportunities to look at individual companies. It's hard to advise people to try and pick individual companies because it's picking winners and losers and there's too many other variables. But picking mutual funds or ETFs that target a particular hot growth area or area that we already know that the Biden administration is going to be using, federal government dollars to make some investments in. How do we benefit by those kinds of things? So there are, those are just a couple of the examples of how you can benefit. Now I just want to spend a little bit of time. Well, before we do this, Millard, how are we doing? Any other questions?
Well, I have a comment. Well, somebody says that she has recently emailed SWIB with the same question that came up before. How are they doing on these investments? And didn't get an answer from them. And then another question is, my portfolio advisor remains more cautious about moving into green investing than I would like. Is there a place to find and vet advisors who embrace this more fully? Yes.
I don't have any immediate recommendations, although because we talked about 95% of millennials are using SRI criteria. I can't believe there is an investment firm out there that doesn't have expertise in SRI options. Regardless of which of the big, investment advisors you're working with, or even smaller investment advisors. I can tell you I'm not aware of any in Madison. There is a group in Milwaukee called Riverwater Partners that is a whole investment advisor a firm of investment advisors, all targeted around SRI. They're also a B Corp, which is how I had come across them. I'm not aware of an equivalent in Madison, but there undoubtedly is. The other side of that answer is these next couple of slides that I'm going to be going through, and that is you sort of give up the idea of working with an investment advisor and work with a robo-advisor, which does everything an investment advisor does, except they're not real, but they'll use analytics. They're going to use, sort of what you're going to fill out some questionnaires about what you're interested in, and then they'll create a portfolio for you. So let me jump into this slide because it's going to answer that from the technology side. Millennials love, technology, and it's been a part of their life, their whole lives. Older investors like us may be reticent to use technology in investment decisions. Millennials clearly aren't. So there is the rise of robo-advisors, which are simply financial tech companies that are seeking to disrupt personal investing. They're seeking to disrupt the relationships that people have traditionally had with financial advisors. So just as manufacturing companies have replaced assembly line workers with robots, these companies replace financial advisors with robo-advisors. They use big data and algorithms to determine the best places to put clients' money. Very popular with millennials. They create investment portfolios from existing investment options, and can be individual companies, ETFs, stock and bond funds. And it all starts with filling out a questionnaire about what's important to you. What are some examples of SRI robo-advisors? So robo-advisors that are really designed to appeal to those that are looking for SRI options. So one of them is called Betterment. One of the first robo-advisors. They offer now an SRI option that is limited to large cap companies, mutual funds, ETFs, and individual companies. They also, probably for demand reasons, offer access to real people as advisors after you set up a portfolio by filling out the questionnaire. Earthfolio is another example. Invests exclusively using 10 separate environmental, social, and corporate governance benchmarks, much more targeted at the environmental side of the ESG world. This one I'm very interested in, and I'm guessing that there are going to be members of the audience that would be interested in this. Ellevest is a robo-advisor that was created by women for women. It was designed along the idea that women tend to live longer, yet earn less than their male counterparts, and they have unique challenges when it comes to money. They earn money early. There's a time for many women that they earn less money because they're spending more time with kids, and then they perhaps earn more money later. It's different patterns of when money is earned and how investment needs to be done. So this robo-advisor was created to understand and meet those needs. So those are the robo-advisors. Before we go on to that, I would say don't be afraid of making the jump into a robo-advisor, but maybe dip a toe into the world. Take a part of the portfolio and use a robo-advisor, one of these, or there are certainly others, to see how do your results compare to the results that you have either in the rest of the portfolio or in that part of the portfolio that existed previously. Millennials love these robo-advisors. It takes the whole, they don't like to talk to us on the phone. And so it takes the person basically out of the, sort of the whole communication thing altogether. And it can say, I really want to focus on carbon reduction as a sort of a focus for my portfolio, or companies that address systemic racism, or income inequality, or whatever their issues are. You can then tailor a portfolio around that, and it'd be the same thing for any of us if we decided, yeah, this would be a good area to dip a toe into the water. Millard, anything else?
While you're on this, somebody asks how to avoid investing in companies that invest in guns and weapons.
So
they covered under these?
So yes, it's not an area that I have looked at, but I think it'd be harder to find a mutual fund that would do this. I think it'd be really easy to find an exchange traded fund, an ETF, and it would be a simple Google search, ETFs with avoiding guns and weapons. And I haven't looked, but I'm going to bet there's 5 or 6 or 8 or 10 of them out there. And then, look at performance over time, and what are you comfortable with? So the ETF world, what ETFs added to the mutual fund world was the ability to thematically invest. There are certainly SRI mutual funds, but it's hard to find, narrowly tailored mutual funds like the ones that I was talking about, that are water focused, or that are focused on racial diversity or whatever. So yes, you can do it. I just don't have any recommendations as to what are the options that are out there, and then how have they performed over time.
I have another
Yes.
question for you. You've talked a little bit about investing in medical health related operations. The question is, we're learning more about environmental costs. For example, the huge environmental cost of healthcare increasing as they use more disposable equipment, presumably for greater protection of patient and staff. How do these assessments of environmental responsibility change as practices and knowledge change?
Yeah, that's a great question. having known people in the medical field well, and actually had them speaking at conferences that I've put on, single-use plastics are by far the biggest challenge. And we have been so worried over the last year with COVID-19. I haven't seen any data about it, but I'm sure the amount of single-use plastics and single-use everything, masks and everything else, has increased dramatically. So how do you balance those kinds of things out? I would say there are certainly rankings on plastic use within the medical field. You could look at which companies are leading. There's a group called Healthcare Without Harm. I think that would be a good place to start. Jeff Thompson from Gunderson Health out in La Crosse, I think, is one of the sort of leads now. He recently retired as the CEO of Gunderson Health, and is very active in the Healthcare Without Harm organization. So on the ES&G criteria, on the E criteria, the environmental criteria, there are, regardless of organization, Morningstar, BlackRock, Thomson Reuters, there are questions about plastics recycling. And so you would be able to find out which companies are doing well from a plastic recycling in the healthcare area. And again, comparisons are always within sectors. And so you wouldn't be comparing non-healthcare companies to healthcare companies. You wouldn't be comparing manufacturing companies to healthcare companies and saying, oh, geez, manufacturing companies are doing much better because of the single-use plastics challenge within the healthcare field. You'd be comparing just healthcare companies with each other. And of course, there are leaders and laggards within the universe of healthcare companies. All right, I want to jump into, I think these are kind of new, but I'm going to call them alternative investment opportunities. And I think by and large, these are not going to be options that you're going to hear of from your investment advisor. And mostly it's because they don't know how to make money on these things yet. So let's say one of the things that's important to us is local investing. What are our options to keep money in the community and keep it flowing in the community? We're really fortunate to have a well-established group called First Forward Community Investment. They're downtown off of Willie Street, actually a little bit further down. But they allow, you can give them $10,000, you can give them $100,000, and in exchange for a low rate of return, 1%, 2%, 2.5%. They're going to invest that money in nonprofits in the Wisconsin area, and might be, infrastructure improvements among those nonprofits, that loans that were taken out. Anyway, they're an alternative to a bank, and they're giving them a much lower rate, interest rate on the loan, because the money is coming from you, and you're agreeing to a much lower interest rate on the money that you've invested with them. So great organization that is right here in Madison. Legacy Solar Co-op is also here in Madison. What they do, they're a cooperative, so you become a member of the cooperative, and you can provide them money, $10,000, to invest in solar panels on a church, on a nonprofit, on whatever it might be. And then the return that comes back on those solar panels, the energy savings, comes back to you. So you're getting your principal back, you're getting interest back, and it's all here in Wisconsin. Juul Clean Energy Assets is also here in the state. Limitation here is it's for accredited investors only. So you have to have $1 million worth of assets to invest with Juul Clean Energy, but that's hydro, but run of the river hydro, so small hydro, small solar and wind plants, those kinds of things. Really interesting stuff. Other alternative investment opportunities, peer-to-peer lending. Prosper has been around for probably more than 10 years now. You are the bank. So Prosper is the intermediary. You give them money, and that you then either choose or have them choose which people that are looking for loans are going to be, getting the money. And so let's say you give them $100 and you say, I don't want any loan to be more than $25. So you have 4 loans that are out there, and the interest rates range from 4% up to 15%, depending on the risk of the person borrowing the money. And you can say, I only want really low risk people, or I want a broadly diversified portfolio. This is something we've been invested with for a long time, and our average return probably over the last 5 years is about 6%. C-Note is another option. For peer-to-peer lending. You're providing money to someone that is doing a business startup or pursuing a dream of theirs. So taking the banks out of the middle, and your money doesn't go to a bank and then the bank lends it. Your money actually goes to the loan recipient. Much like peer-to-peer lending is microfinance. Microfinance, the organizations here, you give them money, you get that money back. Kiva is the largest of these. You give them money, you get that money back. You don't get any interest on it, but these are loans for poor people in the developing world that don't otherwise have access to capital. WCCN is located here in Madison, as is Envest. Same thing, microfinance organizations, both of them will pay you interest on the money that you give them, that they then provide to a partner in the developing world that loans that money out. And then as that money is repaid, you're getting repaid with interest. And interest rates are decent. Any interest rates are better than what we're getting at the banks these days. Then if you get, if there's a small part of your portfolio that you're willing to take a little additional risk with, these are all crowdfunding sites. So you're supporting individual startups. These are probably the more established, longer track record crowdfunding sites. Seed Invest, WeFunder, Fundable. Cropital is, as it says, it's really focused on agricultural loans. And then, real estate should be part of everybody's portfolio is what the rich people say. And it's always been hard for non-rich people to participate. All of these organizations allow people that don't have millions of dollars to participate in the real estate world. So worthwhile checking out any of these. And then as you think about investing, you can integrate values, your values for the environment, social equity, responsible business decisions into your investment decisions, and you're not sacrificing return. So really the overall message of this is, yes, you can invest with values. And if anybody tells you, oh, you have to choose return or values, you need to find another person, because that is simply not true. It hasn't been true for the last 5 years. 2020 saw a huge amount of money sort of come in to the field because we have put aside that argument that it's either values or money. It isn't. In fact, picking the companies that are more values-based actually gives you a better return. So with that, thank you all for indulging me in this. I am not a financial advisor. I have no background as a financial advisor. It's just a field that I have spent a lot of time thinking about. And I always welcome opportunities to talk about it. Millard.
Well, here's just a fairly specific sort of question. What about investment options within TIAA-CREF and deferred compensation? You can't move funds without penalties.
So TIAA-CREF is the whole firm is an SRI firm. So all of their investment options are SRI compliant. It's not to say that because of the limitations of TIAA-CREF, you probably don't have options in investing in some of the ETFs that we talked about. So, I mean, I think every time that one of us asks the question about what are my options, why don't I have more options, the field receives that and realizes that the world is changing and they need to be able to respond to those changes. And so as we request more SRI options, more access to thematic mutual funds or ETFs, more access to green bonds, eventually we will get more of that.
Question, how do we know that companies like BlackRock are not speaking with forked tongue? They used to be one of the highest backers of fossil fuel projects. They're now part of Ceres and have an iShare SRI side of the house. Do they still have their non-SRI side of the house and then their SRI side? So what's
So
the
BlackRock, yeah, I mean, BlackRock it's a really interesting example. I think BlackRock might actually be the largest. So their investments are larger than any other institution in the world. I think that is the case. And for the last 3 years, their CEO, and I'm drawing a blank on his name, has put out a letter each January. And 2 years ago, or 2 letters ago, so 2 Januaries ago, he was very strong on the side of climate change, that companies that were going to be included in their portfolio, and they're a multi-trillion-dollar portfolio holder. So companies want to be included in their portfolio, needed to be able to talk about what they were doing from a carbon and climate perspective. The letter that came out about 10 days ago for the 2021 year, Larry Fink is his name, re-emphasized the importance of climate, but addressed some of the social issues now. So you have a CEO that very publicly kind of lectures the business world on the movement from a shareholder orientation, and that sort of responds to the Friedman proposition that business is in business to make money for shareholders, and has said that's not true any longer. That is the old way of thinking. Business is in business and will do well in business if they think about the environment, if they think about the communities that they operate in, if they think about this playing a role in addressing social issues that are out there. And so, yes, is there a likelihood that an organization as big as BlackRock is still doing stupid things from an investment perspective? I think yes. But I think as you look at the public positions that they have taken, they are transitioning, and they are probably leading the transition because of the visibility of their CEO and these letters that he puts out. It's a great question.
Thanks. You've mentioned relative returns from these types of investments in recent years. Financial investments have done pretty well. How about these funds? How do they compare with the broader market in down times?
Let me answer the question from 2020, because even though the market was up, as we saw 18%, S&P was up 18% for 2020. We saw a big dip right in March where the market was in, well, beyond correction territory. So down 20+%. That was where the SRI funds, mutual funds, ETFs, individual companies really outshone their peers. So it's a very small look at how do SRI options comparatively perform against non-SRI options, but they did spectacularly. That's, sort of explains the overall outperformance over the course of the year. It was their superior performance during the market downtime, which is consistent. I mean, again, what we've argued is these companies that are committed to sustainability, to socially responsible kinds of issues, they're managing their risks better. They're doing a better job on sort of minimizing their cost of capital. If they're borrowing money, they're getting better rates. They have better management teams, and so their stock market performance should reflect all of that. So the last major longer economic challenging time were the 2008, 2009 downturn. And I'm just going to guess that the SRI field relatively well during that time, although I haven't looked at it. So that would be more than 10 years ago. So it'd be outside of because Morningstar goes back the last 10 years as the longest performance time horizon that they look at. So I can't answer that because I think that's the window that we should be looking at, but the market crash, the bottom falling out of the market in March of 2020, I think is a good representation of how the field should do overall in a market down time.
Somebody asks, talk about investing in REITs. It's hard to get out of now. So many office buildings with empty offices.
Yeah,
people will continue to work from home.
I'd avoid it. I mean, so with REITs, with REITs, real estate investment trusts, there are lots of flavors, right? There are commercial flavors of REITs, which are the office buildings. There are industrial REITs. There are new home construction REITs. There are multifamily existing apartment building kinds of REITs. I guess the only one that, I mean, if somebody said, here's $10,000, you have to put it in a REIT. The only one that I would really consider right now would be an industrial REIT. So they would be holding industrial properties because factories have come through this downturn much better than office buildings, retail establishments, hotels, all of those kinds of things. I mean, and this is, way more than what they're asking for, but I have been worried all of 2020 that the market is not reflecting the economy at all. And I still worry a lot about that. I think with Biden's, if he's able to get his $1.9 billion COVID-19 package through, that's going to address, I think, the greatest challenges for the market at this point, and that is the number of people and businesses that are behind on rents that really have no prospect of ever catching up anymore. And so that money would help them, which then helps the landlords, which then, sort of means the economy is not going to take the tanking that it would otherwise. I mean, for all of these people that aren't paying rents, their landlords are still making property payments, right? I mean, I'm not a landlord, but if I, had a rental property, the bank's not telling me, oh, geez, there's a pandemic and an economic, challenging time. You don't have to make payments. No, I mean, my obligation is still making those payments, even if somebody's not paying me rent. And I get why they can't pay rent. They haven't had a job for, 6 months. Especially, in the, sort of the rental areas that are affordable in Madison. Most of these folks live and work and they live, their livelihoods are determined by bars, restaurants, small retail, hospitality, all of which have been hit tremendously hard. And so where are they going to get money to, I mean, I get why they're not paying rent, but nonetheless, it's a huge problem, and it's a multi-billion-dollar problem right now. Way long answer to your question about REITs. I think if you reach the point where you say, oh yeah, it looks like that 1.9 billion is going to go through, the economy is not going to go through a double dip recession, we're on the road to recovery, then dipping your toes into REITs, there's going to be money to be made, because they're all struggling right now, mostly because of uncertainty. And so as certainty is introduced back into the market, that there's I think an opportunity to make some money, but I think it's too uncertain at this point.
Okay, one more question. Some in elected policy positions, not to mention political affiliations, are quite consistently opposed to environmental regulation on the basis that this will limit business returns and economic growth. Is there an effort to change their position? How can we as citizens support policymakers being better informed on this issue? Have you seen a change in how state and federal policy folk view this issue?
All right, so now I have to preface this with it's a little bit of a political question for me.
It's definitely political question.
Yeah, I mean, this is another one of the settled areas. There is no factual disagreement that there's no factual support for a proposition that environmental regulation harms business competitiveness, business success. That's been put to bed 10 plus years ago by repeated studies from very well thought of institutions. And so this, sort of jobs or the economy versus, protecting the environment, it's a false, argument. So, the question is, how do we convince people that environmental regulation doesn't harm business competitiveness? I don't know. I mean, there is loads of factual study after study that shows businesses that get ahead of the environmental curve do better overall, and that yes, there are businesses out there that are always going to be the laggards, that are always going to say, geez, I am in a better position if I don't have to spend this $100,000 putting these environmental retrofits in place when all of my competitors do. I am at a competitive advantage, but those companies are at a competitive disadvantage from the way that their management is thinking. They are not thinking about how are they going to be successful a year from now, 2 years from now, 5 years from now, and how they're going to be around. So the long answer to the question is, I don't know how to change people's minds about these issues. The facts are the facts. People that are still making these environmental regulation is bad for business. There is no factual basis for that argument any longer.
Well, Tom, I think we've run out of questions, so I'm going to thank you for a wonderfully interesting seminar on a subject that I think most of us haven't thought very deeply about. It was a great seminar. It's obvious why you are the holder of a number of teaching awards. Thank you so much.
Thank you all. And again, remember, yes, you can invest using your values and not giving up return. That's the take-home message from this. Thank you all for tuning in.
And thank you. Don't forget to fill out the evaluation, folks who are in the audience. If you hit the leave button, screen should pop up that gives you an opportunity to give us some feedback, and we appreciate your feedback. And again, thank you, Tom Eggert.